My name is Jan Piotrowski. I'm the Economist business editor, and I'm here to talk to you about what banks can do to speed up the green transition, and have a wonderful panel of experts to accompany me. The first is Mohit Joshi, who is the president at Infosys. Isabel Fernandez Niemann, who's a former board member and champion of sustainability at ING Bank. And André Abadie, who's the managing director for the Center for Carbon Transition at JPMorgan Chase. Welcome, everyone.
Thanks.
Clearly not enough coffee just yet. We'll get there. So my first question is maybe just a very broad one, and maybe, Isabel, I can start with you. What is the role of banks in the green transition? It's...
Well, it's a straight to the point question. The role is enormous. Back in 2015 or so, there was very little awareness. People were very, most corporates were not very much focusing on this, bar a few. Then I remember standing on a stage in 2018 in San Francisco at the Global Climate Action Summit, where we said we're going to go as ING and be completely transparent. Third-party created scientific scenarios to meet Paris, and then to end that. And we committed to 2050 to actually align ourselves. It starts with that, right? Once you are aware and you commit, then the first thing is, what's your portfolio? Because we were carbon neutral in 2015, but that doesn't say anything if you've got a billions and billions portfolio. So one is really make sure that you measure your portfolio. Two is, I think, engage with your clients and don't let this be a topic at least of an annual conversation. Number three is invest, and we put up a 300 million equity investment to support those things that weren't ready. And then ultimately, it's going to be part of your terms and conditions. This is not nice to have. This is needs to have.
So that's sort of a good, a very reasonable high-level answer. But when you actually look at the sort of sphere on which banks and public markets have an influence, I think we had a calculation, I think, last year, which basically put the carbon emissions of publicly listed companies over which capital markets have sway at something like 10 gigatons, which is not inconsequential, but it's a quarter, it's less than a quarter, it's a fifth of overall emissions. So, André, how can you sort of maximize banks' impact, given that they only really have sort of a direct effect on a relatively small portion of the world's emissions?
It's a question I think we are grappling with daily, because we have set $2.5 trillion commitment over the next decade to finance a lot of both development and environmental social impact financing. It is, as always in these discussions, it's a question of blended finance. So how can you actually use public finance to leverage private capital in order to find the solutions which do reach the entirety of the global economy? I think that is absolutely something we are focused on. The scalability point, I think, is what's going to dominate for the next 8 to 10 years in our view, in the sense that a lot of where the capital needs to go is to scale up the solutions, certainly from a climate perspective, that we already have. But then certainly once you start looking at what really needs to, again, from a climate perspective, start bending the curve and reducing emissions down towards net zero in 2050, you'll probably have seen the IEA in its NZE forecasts, or this scenario, has basically said a lot of that technology is not yet economically scalable. So again, the question for us is, so what is our role as a bank? What you'll find is banks aren't typically willing to take high risk on some of these transactions, whether it's green hydrogen deals, direct air capture, which is at $700 a ton of carbon, that type of thing. So there is an open question as to where is it we can actually play a role from a scaling perspective, but where through a blended finance or blended capital model can we see public capital coming in to take the first loss and then try and scale up from that point onwards.
Are you seeing that?
We're seeing it in some parts. I mean, I'm sure a lot of people have seen Bill Gates is going in on 4 technologies, really investing a lot. So that's green hydrogen, direct air capture, sustainable aviation fuels, and carbon capture and storage.
And nuclear.
And nuclear. But each of those, I mean, if you actually look at it, to us, direct air capture and carbon capture are kind of like tailpipe. You know, that's, if you haven't succeeded in actually getting emissions down, then you need to start looking at them, at those technologies. Sustainable aviation fuels is, you know, one sector. But green hydrogen, I think, is where certainly internally a lot of the conversations are right now. How do we start focusing on the entire ecosystem around really getting green hydrogen scaled up? Because that does look like one of the more significant technologies we need. And Germany, you've seen $200 billion commitment, amongst other things, towards green hydrogen. So that, to me, is where a lot of the focus is.
Mohit, so your company, helps many companies transform themselves digitally and make themselves more efficient and better run. What do you see as the areas on which banks should be focusing, especially in the short term, when it comes to the green transition?
Sure. So look, I think, for us, we come to this from a position where we have ourselves become carbon neutral as a company. We were the first large system integrator to become carbon neutral across scope 1, 2, and 3. Obviously, in working with a lot of banks, the first issue is the data issue, right? Making sure that people have a credible basis on which to measure, especially scope 1 and scope 2 emissions. Scope 3 is a slightly more complex issue because the parameters of what is included in scope 3 are still being thought through. But I think the first phase is the definitional phase, identifying what you need to do to accomplish carbon neutrality across scope 1 and scope 2, what your current carbon footprint is, both for yourself and across the supply chain. This is the first issue that we're working with our clients on. And secondly, identifying, from their balance sheet perspective, what are some of the things that they need to do to reduce the carbon load of the investments that they've made. And really, across the board, you're seeing banks and insurance companies have made commitments about when they will become carbon neutral. A lot of these, or all of these commitments need to be vetted by their own audit committees, right? So the degree of, accuracy that is needed from a data perspective is really very high. And I would say that that is the first piece of work that we're going to be working on. Going beyond this, obviously, there's also a question of how do we work with our clients to reduce the resource intensity. Something like 10% of all greenhouse gases because of commercial real estate, and obviously financial services companies occupy a very large footprint over here. How can we reduce the energy intensity of buildings? How do we reduce the energy intensity of travel, for instance? So these are areas that we're working with our clients on.
Isabel, so banks, they channel capital to hopefully to its most efficient use. But a lot of the talk nowadays in investment circles, in ESG investment circles, is about whether capital should be flowing out of companies which are dirtier and into companies which are greener. But that obviously poses a problem if those dirty assets are going to be snapped up by someone who is less concerned about the energy transition. So how should banks think about that?
Well, let me give you a very specific example. So this is back in 2019. We'd already said we're going to get out of coal by 2025. Any company that has more than 5% of coal, that's the maximum they're allowed, because sometimes you have these very minimal pieces. Anything beyond that, we will no longer do. That's 2025. So this is now 2019, and a big client of ours who did a lot of things on the renewable side, but had their projections still about 18% of their business of coal by 2025, did a refi in 2019. So the teams come up to me and say, Isabel, we're going to do this refi, but don't worry about it because I'm sure we'll refinance another time before 2025. So I was sitting here with the board, big client, lots of income, and I say, listen, if we're going to be serious about this, we're not going to postpone this decision to then. So we literally said, we're not going to roll. Now, the conversation I had with the CFO was a disaster because I was given the earful that I was, of course, there was plenty of banks, la, 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 la. This is 2019. I'll bet you right now that conversation is tougher with that particular CFO. So there is, unfortunately, going to be negative impact sometimes, decisions you make, and you have to make often at board level to say, let's just not do this. So the problem with ostracizing is exactly like you say, then they go to some shadow system where nobody maybe cares, and you can make a lot of money on some of this stuff right now. Even in the stranded assets, you see a lot of money being made. So it's part of it. But unless you are prepared sometimes to make those calls, I don't think you are truly serious.
Are those calls, I mean, how much more often are those calls being made, do you think?
Well, much more often, much more often. And also, you've seen an enormous pressure now on the risk side, right? So we started with awareness, now everybody's measuring, whether it's regulators, banks, politicians, you name it. And now we're getting into, okay, so what does that then mean? If you look at it from a risk perspective, here's what people are saying. Okay, if I do that 7-year deal now, what's the risk in 3 years' time of this asset, right? Of the deal not refinancing in 3 or 4 years' time, because everybody assumes everything's going to be rolling. So I think people are flipping it now to the risk side, and some people have been very vocal about that climate risk is now becoming a real risk also to financial institutions. So you better actually measure it. That's positive.
But is that regulatory risk or is that physical risk?
A mix of things, but no, it's not mostly regulatory risk. People are mostly worried about the risk of the asset not being able to refinance. And then you're going to be the last man standing, the last lender who's in there because everybody's pulled out, just like I pulled out of that deal, right? The next refi, you're sitting with an asset. Sometimes you have fixed 15-year assets. You're sitting in there. What are you going to do after, while people can't repay, you can't bail out? So it's not just an issue for the owner of the asset, but also for the lenders.
André, this is a related question. So, I think, again, our analysis which showed that only about 20% of global emissions come from publicly listed companies, also showed that of that 20%, something like 3/5 came from oil and gas and utilities, so 2 sectors. The vast majority of sectors, they don't really make much of a dent at all. So presumably, like a genuine, sincere decarbonization strategy would be focusing on those high-emitting sectors. But the problem here is obviously that if you sort of disown them, literally, somebody else with fewer scruples might come in. So, what is your approach to the high-emitting sectors? Is it divestment? Is it engagement? Is it a mix of the two? How can banks influence the biggest corporate emitters on which they have some sort of sway?
It's all of the above. I think a few things are going on within GFANZ. You may have seen there's a conversation now around responsible retirement of assets. I think to the question you're asking, because I think what Larry Fink that was saying, there's a lot of greenwashing, which I guess we'll probably get onto in this conversation, but we're seeing a lot of greenwashing in the market. And from Larry's perspective, his concern about greenwashing is that a company gets rid of an asset and says, look how clean I am, but that asset is still operating. So I think that is a dynamic we're acutely aware of. And therein lies the rub, because if you're setting these targets to say, I want my business with this client to reduce in terms of carbon intensity over a period of time, a lot of that assumes that clients are going to get rid of some of these assets or retire these assets or sell them to someone else. And then you're not, from a broad environmental perspective, all you're doing is moving the asset somewhere else. So that is a concern and a consideration and a discussion we certainly are having right now. I think, yes, the majority of emissions are in the fossil fuel sector, but let's not forget that as we move to a model where we're increasingly electrifying the global economy, and you take a look at things like aviation, steel, cement, that is also carbon intensive because it's reliant on the fossil fuels in order to produce whatever those building products are. So yes, there's a dynamic of focusing on the supply side, but the demand side equally is important. We need to think of it in an ecosystem. And if we are trying to work with an oil and gas client to reduce oil and gas production, then what are the alternatives for steel and cement if they don't have the raw materials to go into that production? So it's trying to get the right balance and the right dynamic and approach, again, the entire global ecosystem holistically to get to the point where, yes, there may be some divestment of some companies, and We've certainly had a few difficult conversations, as ING did, with a couple of names. But first and foremost, when we set out our Paris targets, the view was we should engage our way to Paris alignment. We shouldn't risk manage our way to Paris alignment by getting rid of these assets. But again, it's easily said. We're now in the midst of actually the dynamic of how is it you structure those conversations and what are the right transition pathways for some of these clients.
So Mohit, we brought up greenwashing, and it's obviously a big concern,
Yeah.
and seems to be maybe even a growing one. And one way to try and avert it, or at least minimize it, would be to have a sort of a transparent view of what the carbon footprint of a particular company or a particular portfolio actually is. So how far along have we got to having this clear view? Because there's a proliferation of various benchmarks and measurements, but how do you have a sense of how good we are at actually pinning down the carbon intensity of various entities?
I think it's very early days. And there is work that is being done from a standards perspective, and there's work that's being done from a data perspective. Quite honestly, till a couple of years back, green was what you said was green. But now you're seeing the regulator coming in. You saw the statement from the SEC yesterday, which I'm sure is going to be followed by fairly detailed rulemaking. You've seen in the UK, the CMA come in with their own set of standards as more and more companies, like I mentioned, right? A lot of the insurers, a lot of the banks are announcing their own, carbon neutral dates. And therefore, behind them, there is a huge computation and calculation that is going on, and a fairly significant amount of reporting going on, where the big four are involved, companies like us are involved, tech companies are involved. And as more and more of this reporting starts to happen, I think you will start to see the data standards start to emerge. I think it's frankly still a little bit early, especially for areas which are not very well defined, right? Like for scope 3. And I understand the challenge. Apart from my day job at Infosys, right? I also work with a number of companies, and I see how hard it is for the large banks, for the large insurers, to be able to measure their true carbon footprint. And the range of estimates, do vary, right? And it is something that will take time for us to quantify.
I mean, I think there's actually a deep philosophical problem with scope 3 emissions, and that's someone's scope 3 emissions
It's
or
a circular
somebody
thing.
else's
It's very
scope 2
circular.
emissions. So
Exactly.
there's a massive overlap.
Exactly.
So avoiding double counting, I think, is going to be something that needs to be worked out, and I'm not sure exactly how to do that, because ultimately, if the oil or if the energy resource producers all accounted for their scope 3, nobody else would have to do anything, right? Ultimately, because the end use is that fuel. Do you, Isabel? I was wondering. Actually, you brought up the SEC disclosures rules, and I was wondering, Isabel, what your opinion of those sort of standards was. Because on the one hand, it seems perfectly reasonable to demand for investors and for governments to demand disclosure and transparency over these over the climate exposures, be it regulatory or physical or legal. On the other hand, it's obviously much easier for some companies than it is for others, right? I mean, it's trivial for many tech firms because they basically buy some electricity and send some people on business trips, and it's. For the scope 2, it's pretty straightforward for banks.
Yep.
For manufacturers, for energy producers, for utilities, gets much more complicated much more quickly. Yep. So is that sort of is this demand for sort of blanket disclosures, is that really fair at the point we are at, as Mohit mentioned, where the tools for actually ascertaining your carbon footprint are only really being developed and not quite there yet?
Well, the obvious answer is no, it's not fair. That doesn't mean that you shouldn't do it. Here's the thing, right? I mean, ultimately, we're in a situation. I mean, what we needed to do in the European side, with regulations coming from the ECB on climate risk and everything else, what you needed to measure was just insane. Same here with the stories on the SEC. Yes, it's unfair, but you got to start somewhere. As I was mentioning earlier on, 2015, nobody really was talking about this. 2019, everybody talks about it. We're unfortunately going to have another 2-3 years where it's all about awareness and measurement, right? And do we measure it? How do we measure it? And it's going to be a pain in the butt for many people to do that. But it's your T0 starting point to then make sure, okay, now we know what you need to achieve. And I'm a much bigger fan of sustainable. We launched the first sustainable improvement loan. And the nice thing about that is that wherever you start, you get rewarded for sustainable improvement. And that is not an exclusive strategy, it's an inclusive one, because you have a different starting point, and this is where the greenwashing comes in, because people will say, well, I'm starting here, and in reality, they're much worse off. But now you're actually measuring, is a company improving? And if they are, you'll incentivize them by getting a lower price on the financing. So no, it's not fair, but you still need to do it.
André, do you agree?
I think fairness is an interesting question. I think, from our perspective, we've recognized that we have to disclose our scope 3. I mean, it's clearly the biggest footprint that we have. And what we have found helpful when we've started looking at our client scope 3 is you can very quickly scale and understand where future material risk could be. Because yes, if a company's got minimal scope 1 and 2, but huge scope 3, they could turn around and say, not for us to worry about. But the point is, someone else is going to have to worry about that, and that's going to come back to bite you if you don't actually understand what those dynamics are going to be. So for us, it's helpful. Also in the sense, it's quite curious because when we've started looking into scope 3, certainly in the oil and gas sector, you very quickly get to a multiple. You figure out, okay, scope 1 plus 2 is, a tenth of total footprint. But then you start very quickly seeing companies who are claiming that their scope 3s are, 10% of footprint. So you're saying, okay, something's wrong here. The math just doesn't work. So we've certainly found it useful from a number of perspectives to really understand where clients' material future risk could be. So that's all about transition. And whether or not clients are actually aware of the materiality of their own scope 3 emissions. So, I think we're not going to move away from it. I think it's an important factor. I think what is more challenging to us is there seems to be a lot of focus from stakeholders and shareholders on us reporting absolute emissions, which when you actually boil it down, fine, it gives you a number which is backward looking, but from an actual management perspective, intensity is far more effective.
Yeah, I agree.
But that seems to get lost on a lot of people, because if we're comparing company A versus B, you want to understand the intensity of their business. And so, that's moving away from scope 3 to an extent, but it's related because, it's fine, we can count as many numbers as you want and give you a big number, and then you're going to say, okay, well, you need to reduce that number. Okay, that's very one-dimensional. What's more important is really understanding the dynamics of how that number is, from an intensity perspective, what that portrays of a company's business and what they can actually do to reduce that over time.
I mean, I think that's understandable though, right? Because obviously the problem with CO2 is that it sticks around in the atmosphere. So it is the absolute emissions that matter most. I mean, if you reduce your intensity but grow your output.
Agreed. No, what I'm saying
that's
is
not helping the climate.
From a reporting perspective, I totally get that. All I'm saying is from a management perspective, when you're actually making decision by decision, it may be that, a reduction in absolute emissions in this transaction of this client will be X and it'll be Y and that, but that's not necessarily going to be that relevant from a decision-making perspective. We've actually seen this in recent times where the intensity of a company that had a much smaller absolute emissions footprint was much higher than a company in another transaction, and that to us was helpful. Yes, we are going to disclose the absolute emissions because with 2050 net zero, that has to get down to zero. That's not lost on anyone. You have to do both, I guess, is the point I'm making.
Can I give you another example
on
that? So an interesting one. I've been talking to a lot of companies about how they're going to do things, right? Because every self-respecting CEO nowadays has got a goal up there, 2030, 2040, 2050. You read very little about how they're going to do it, particularly how they're going to do it in the next 36 months. You read very little about that.
Which is when the CEO will still be in charge.
Yes, exactly, which is why they have a goal of 2030, because the likelihood of being in charge is much less, right? So, I mean, it's being cynical, but here's the thing. I was talking to this...
Not unreasonably.
Benelux beer brewer, living in Amsterdam, you probably know who it is. And they're they're far ahead of this stuff, right? I was a student working there with them 30 years ago and we're recycling beer bottles. I talked to them about wastewater to liters of beer, and they're way ahead of the pack. So that's a typical intensity measurement. So if you could take their best practice and roll it out to every beer brewer in the country, in the world, that intensity matters. And it's not CO2 emissions, but it's wastewater, really important. So I agree with you on that point very much.
Can I ask, the thing I wonder about greenwashing, and Mohit, I'll direct this at you. So, as we have this mushrooming of various standards at the moment, and you also have a huge pile-in of both companies and investors who want to do something. A few years ago, it was only the really truly committed who are doing something, and there are fewer standards. So in a way, both the opportunity and the motive for greenwashing sort of has increased in a way, right?
Yeah.
Because you've got more tools to greenwash because of the proliferation of standards, and you've got more people, fewer of whom are deeply committed. So is there like another inflection point in that curve that you see where we will get less greenwashing because of some sort of factors and pressures?
Well, I think that the single biggest factor driving greenwashing has been the financial incentives, right? At the end of the day, the financial markets have stated a very clear preference to go for green assets rather than, brown assets. And so you are seeing this gigantic flow of investments, and you are seeing just a gigantic amount of money waiting on the sidelines looking for assets to invest in. And so, as you can imagine, for people whose scruples are less than ideal, will be using this opportunity. But I think the situation is getting corrected quite quickly. I think, as Isabel mentioned, I don't think we need to be cynical, because with regulators coming in, and I think it's quite admirable, right, that people like the SEC are actually jumping into this debate, because the reality is that if I, as an investor, am making a certain choice to buy an asset based on a statement or a declaration made by a company about their green strategies or about their investments, then that statement, just like any other statement that they have about their, their financial strength or about their, their product portfolio, should be accurate, and that the management team should be held accountable for it, right? So I feel that with more data being shared across companies, with more industry data being available to us, right, so that we can compare energy intensity and resource intensity across companies. And look, at the end of the day, when this data business in financial services is 30 or 40 years old, if we look at the business, and S&P has built a business, or Bloomberg has built hundreds of billions of dollars, there are gigantic data businesses that are being built today around sustainability, around resource intensity, around green. And I think we will see these being built, and these will be the standards that people will then use to say whether an asset is green or not green.
So there's obviously a lot of capital trying to chase these green investments. Is there a green bubble? We had one
for sure
10, 12 years ago. Isabel, what do you think? Is it about to pop? I mean...
Yeah, partially, I think look at the returns you get on financing green assets. They're pretty bad, right? I would have these people come to me and say, well, on our balance sheet, we need to have X% of green assets. I said, those green assets, the world can find easy money for them. Why would I suck up my balance sheet with them? I'm much better off growing the polluters to being more, greener. So I'm not a fan of that. I think there is probably a bit of a bubble, but then again, there's I don't worry about it too much, because the returns you just get on green assets nowadays is just relatively low. So if funds that are focusing on green and ESG more broadly, don't forget social and others, but if it's climate, they will try to figure out a way to also get yield, because there'll be competition. So you'll see them, goes back to this greenwashing story. So I think it will last a little while before you really see a massive problem with the bubble bursting and everybody losing money.
André, and do you think that the bubble is poses a secular risk for the green transition? I mean, if the returns are low, and if there is a risk of the bubble popping, doesn't that chill enthusiasm for investing in those sort of areas?
Potentially. I don't know if I'd see, just given the scale of what we need to invest, you've seen McKinsey talking about 9.3 trillion a year. Our estimation is anywhere between 3.5 and 5 trillion a year. So we need green assets, period. What is part of the issue is there isn't enough supply. There's too much demand, which is why, to me, there's as much greenwashing as there is, because people are desperate to have anything they can call green. So I don't know if there's going to be a bubble burst. I think it's going to be a correction, hopefully, where we can actually cleanse a lot of what isn't green and rather focus the investment into areas where we should be. And yes, there may be investors who don't have that appetite, long-term risk, technology risk, but that is, again, comes back to the blended capital model, which is someone needs to start taking risk capital here. that's likely to be public finance before certainly the banks step in on some of these deals.
Well, unfortunately, we've run out of time. I'm sure we could have easily gone on for another half an hour. But thank you very much. Could we please have a round of applause for the speakers? This was much more enthusiastic, the caffeine clearly kicking in. Thank you very much. And I would like to hand over to the next panelists.
Thank you.
Thank you very much.